Indeed, we can extend this basic accounting equation. To talk about that, let's go back to our example of the coffee shop. Okay, let's say that today is, as an example, today is January 1st, and today I begin my own business when the total dollar amount of assets that I own, that are either financed by banks or equity is, say, $1 million. Out of $1 million, I financed from bank 900,000, and my own is 100,000. Okay, I opened my business on maybe January 1st is sort of too much holiday, I say. February 1st. Okay, I began my business on 9 a.m. of January 1st. And then during the day, I began to sell my cups of the cups of coffees, say, selling a cup of coffee at $2. And the business was going okay, selling 100 cups of coffee a day. Okay. And then how much money did I sell? How much dollar amount of coffee did I sell a day? $200, right? Then can I say that I became 200 richer than the day before, say January 31st? No, not yet. It's too fast, right? Because I expensed some of the cost to make a cup of coffee and sell the cup of coffee at $2, right? We should take out the cost to say my earnings, my income, right? Indeed, the $200 that we wrote down here is sales. Right? It is just sales. We need to take out expense from the sales to talk about the net income or earnings of the day. Usually it is said that in small business, you need to have like 40% of the ratio, 40% or less of the expense to sales ratio. Let's assume that the total expense to make a cup of coffee is 40% of $2, which is, how much is it? 80 cents. To make a cup of coffee, I expensed 80 cents. So to make 100 cups of coffee, I have used $80, meaning 120 at the end of the day. 120 of net income I made. I am saying that at the end of the day, I became 120 richer than the day before, which is January 31st. Let's close our book, meaning as of 7 p.m. of the day when I closed my store, what's the change in our basic accounting equation? The liability, is there any changes my debt? The amount of money that I owned from my bank, from the banks? We didn't say anything about that. So there's no change in the liability part. Now is the claim to my own self, right? What's the change in my own equity? As a result of this business, one day of amount of business, I became, or my company became $120 each year, meaning by this net income, my equity, the claims to me, has been increased by 120. As a result, the equity is not $100,000, it's now $100,120. And my assets is not 1 million, but 900,000 plus 100,000 and 120, right? You sum this and that. So your new assets at the end of the day is 1 million and $120, right? Okay, I felt it's really good. At the end of the day, I became $120 each year. Then the last day, I felt it's so exciting, right? So I decided to take out 30 bucks from my cash register, and then buy some flowers for my family. Okay, what happened extra is I took out withdraw money from my cash register of 30 bucks. Then what's the change? What's the ending balance? Revised ending balance? We can say that now the equity has been shrunken by $30, reaching to $190, right? Again, 120 minus 30 is 90 bucks, right? As a result, I subtract 30 from 100,000, 120, which is $100,090. There is no change in my liability. Then, how much is my total asset? Now it is $100,000, $100,090 plus $900,000, which is $1,000,090, right? This is my new assets, which is $1,090, and my liability is the same. My new equity, originally it was $100,000. Now it is $100,090, right? Let's wrap up. What happened? Your assets is equals liability, and our equity is affected by many factors. First of all, we begin the day with $100,000, which is my original owner's capital. And then to the $100,000, I added up the sales, which is 200, and then subtracted expense, which is 80. So that my ending result was $100,000 plus 120, which is 100,000 and 120, right? Again, which is the same as $100,000 plus 200 minus 80, which is 120. 100,020. What I'm saying is your equity is affected by sales, which is an increasing factor, and by expense, which is a negative So you can add sales and you subtract out expense, right? Now, what's the final factor? When you withdraw money from your company's cash register, right? Your total equity is shrinking from 100,000, 120 by the amount that you withdraw money, which becomes $100,090. So you subtract out the amount that you withdraw. So we can see that in this example, equity can be decomposed into owner's capital plus sales minus expense minus owner drawing. This is called extended accounting equation. Okay, it's sort of too much in one small space. Let's write down again. Your basic accounting equation is, can you recall? Shout it out. It's assets equals liabilities plus, what is that? I can hear you. Come on, equity. And then we extend it. The basic accounting equation right away. What was it? Assets equals liabilities plus the extension was about the equity part. What was that? First, we added the net income when the net income itself is sales minus expense, right? But don't forget that at the beginning of the day, you have owner's capital. And at the end of the day, I decided to buy flowers for my family, which means you subtract out that drawings. From the balance, your equity balance, right? So we defined two accounting equations, beginning from basic accounting equation. What was it? Do you recall? Can you do that? What is that? Come on, guys. Shout it out. Assets equals liability and, right, equity. Then what's the next extended accounting equation? Assets equals liability plus sales minus expense plus owner's capital minus owner's drawing. One more time, asset equals liability plus sales minus expense plus owner's capital minus owner's drawing. Are you ready? Give me the answer. Extended accounting equation equals assets plus assets equals. Come on, guys. Come on, guys. Right, I can hear your answer. Assets equals liability plus sales minus expense plus owner's capital minus owner's drawing. That's correct. Indeed. So far, you've seen that I am speaking something like financial statements. Do you remember that? Right. I've talked about financial statements using the SEC's EDGAR website, right? Financial statements, plural, right? Then what kind of statements do we have? One of them is called income statement, which is indeed nothing but this part of the extended accounting equation, which is sales minus expense equals net income. That's exactly what income statement describes over a certain period. It can be income for the year, it can be income for the month, it can be income for a quarter, right? Depending on what kind of information you want to generate, you want to provide for your investors, for your external users of the information. Okay? Another statement in the financial statements is so-called statement of ownership, which shows beginning balance and ending balance. And any changes in between. Like, for example, net income. What's net income? Net income is sales minus expense, right? By the size of net income, sales minus expense, right? Net income is the result of this subtraction. Sales minus expense equals net income, right? By the size of the net income, by the amount that you earn the money, your equity increases. So we can say that net income is an increasing factor toward your ending owner's capital. But we also saw that at the end of the day, I withdraw money from my company's cash register, which is a negative factor toward your ending balance of owner's equity. That is, when there is owner's drawings, it decreases my ending owner's capital. This is a simplified world case, but in the real world case, you will see more often not statement of ownership, but rather statement of shareholders' equity. Okay, and we've seen that I explained as if there are only two factors that affects the changes in your statement of ownership, but there can be multiple other reasons that you can see at the last video for chapter 1 when we discuss about when we see some of the real world examples. So hold on that question for now if you have it right now. So what I've explained so far is this part of the extended accounting equation is nothing but the income statement. And this part, the entire equity part, is indeed the information contained in the statement of ownership. And this entire part, assets equals liability and equity, is indeed the information contained in balance sheet. All right, let's finish the discussion here, and then in the next video, let's talk about some of the real world cases from the SEC Edgar system. All right, stay tuned.